The closing event and escrow. In this section, you learn that closing is the culmination of the real estate transaction, where the buyer pays the purchase price, the seller transfers title, and everyone pays their agreed costs. Closing is not just a single moment, but the end of a process that starts when the purchase contract is signed. Between contract and closing, the parties work through inspections, repairs, appraisal, loan approval, title work, and final walkthroughs. A key concept is escrow. Escrow is the use of a neutral third party, escrow or closing agent, to hold money and documents and only release them when all contract conditions are met. The buyer deposits earnest money, down payment, and loan funds into escrow, while the seller deposits a signed deed and other documents. Once all conditions are satisfied, the escrow agent releases funds to the seller and the deed to the buyer. You also learned that lenders often use escrow accounts after closing to collect monthly portions of taxes and insurance with the mortgage payment, PITI. This protects their collateral and helps buyers budget for large bills. The section emphasized the importance of choosing realistic closing dates, understanding cure periods, and recognizing that time is of the essence means deadlines must be taken seriously, not casually. RESPA, TRIDE, and title insurance. Here you saw how federal consumer protection laws shape the closing process. The Real Estate Settlement Procedures Act, RESPA, was created to make settlement costs transparent and to eliminate kickbacks and unearned fees. It applies to many residential, federally related mortgage loans and governs how lenders and settlement providers disclose fees and handle escrow accounts. Later, the TILA/RESPA Integrated Disclosure Rule, TRID, combined RESPA and the Truth in Lending Act disclosure requirements into two main forms: the loan estimate and the closing disclosure. You learned that borrowers must receive a loan estimate within 3 business days of a completed application and a closing disclosure at least 3 specific business days before consummation of the loan. TRID also sets tolerance rules so lenders cannot increase certain fees beyond defined limits without curing the difference. This section taught you that as an agent, you are not issuing these forms, but you should understand them well enough to explain timing, basic content, and why a closing might be delayed if numbers change too much. The section also introduced title insurance. Title is the bundle of rights associated with ownership. Title insurance is a one-time premium policy that protects against covered title problems arising from the past, such as undisclosed liens, forged deeds, or recording mistakes. The owner's policy protects the buyer and their heirs up to the purchase price, while the lender's policy protects the lender up to the loan amount. If a covered claim arises, the title insurer may pay the claim or correct the defect, and may then pursue whoever caused the problem. Financial settlement of the transaction. This section focused on how the closing statement translates the contract and loan terms into actual dollars for each party. The key concepts are debits and credits. A debit is an amount a party must pay at closing, while a credit is an amount a party receives or has already paid. For the buyer, debits typically include the purchase price, loan fees, escrow reserves, prepaid interest, and other closing costs. Credits include earnest money, the loan amount, and any seller or lender credits. The difference between the buyer's total debits and credits is the cash the buyer must bring to closing. For the seller, credits usually include the sale price and prorated amounts owed to them, such as reimbursed taxes or prepaid rents. Debits include lien payoffs, commissions, transfer taxes, title charges, and prorated items owed to the buyer. The difference between seller credits and debits is the net cash to the seller. The section distinguished between non-prorated items, which belong entirely to one party, and prorated items, which are shared and allocated based on ownership periods. You learn to think of the closing statement as a big balancing sheet that must account for every dollar moving between buyer, seller, lender, and service providers. Computing prorations. In this section, you learn the two main methods used to calculate prorations: the 12-month 30-day method, also called the 360/30 method, and the 365-day method. Both methods aim to fairly share expenses or income that overlap the closing date. Under the 12-month 30-day method, you assume a 360-day year, with 12 months of 30 days each. For annual items, you divide by 12 to get a monthly amount, then by 30 to get a daily amount. You multiply the daily rate by the seller's days of ownership in the period to get the seller's share, and subtract from the total to get the buyer's share. For monthly items, you divide the monthly amount by 30 to get a daily rate. Under the 365-day method, you use the actual number of days in the year and month. You divide annual amounts by 365, or 366 in a leap year, or monthly amounts by the actual days in the closing month. Then you multiply by days of ownership for each party. This method can be more precise and is often used for taxes and some local charges. In most markets, the seller owns the property up to and including the day of closing, unless the contract says otherwise. So that day is charged to the seller. This section taught you that the method used 360 divided by 30, or 365, and who gets the closing date should be spelled out in the contract or follow local custom so there are no surprises at the settlement table. Taxes due at closing. This section explored the taxes that appear on closing statements and how they are handled between buyer and seller. At the transfer level, many states and some counties or cities impose transfer taxes or documentary stamp taxes on deeds, and sometimes on mortgages or notes. These taxes are usually calculated as a rate per $100 of sale price or loan amount, and may need to be rounded up when computing the number of taxable units. Who pays these taxes depends on state law and negotiation, but they must be accounted for as debits on the closing statement. More importantly, you studied how property taxes are prorated. Property taxes are often paid in arrears, meaning the bill that comes due later covers a period that includes time the seller owned the property. The fair approach is that the seller pays the portion of taxes for their ownership period and the buyer pays for theirs. If the seller has already paid the full year, the buyer reimburses the seller for the buyer's share. If taxes have not yet been paid, the seller's share is typically collected at closing and held or applied so that when the bill arrives, the buyer is not paying the taxes for time the seller owned the property. You also saw income tax examples, showing how the IRS allocates property tax deductions between buyer and seller based on ownership, even if one party did not physically pay their share. This reinforced the importance of carefully prorating taxes in the contract and closing statement so that economics and tax treatment match as closely as possible. Closing cost calculations. Case study. In this section, you applied all the concepts to a real-world style case study. The example showed a seller couple and a buyer couple in a conventional loan purchase. You watched how the seller's commission was calculated as a percentage of the sale price and charged as a debit to the seller. Real estate taxes were prorated using the 12-month 30-day method so that the seller paid for the months and days of their ownership inside the tax year, and the seller's unpaid mortgage interest for the part of the closing month was calculated and debited to the seller because interest is paid in arrears. You also saw how the buyer's loan costs were handled. The origination fee and points were each a percentage of the loan amount and debited to the buyer as closing costs. The lender required the buyer to fund an escrow account with several months of tax and insurance reserves, which were also debited to the buyer. On top of that, the buyer had to prepay interest from the day after closing to the end of the month. So their first regular mortgage payment would cover the next full month and be due the following month. This case study helped you see that every number on the closing statement traces back to something: a contract term, a loan term, a tax law, or a service invoice. By walking through each component, you learned how to read a closing disclosure and settlement statement not as a pile of random figures, but as a story about how money moves between all parties in the transaction. TILA/RESPA Integrated Disclosure Rule and the H-25 Closing Disclosure. This section went deeper into TRID and the structure of the H-25 Closing Disclosure form. You learned that the lender must give the borrower a loan estimate early in the process, and then a closing disclosure with final terms and costs at least 3 specific business days before the borrower becomes obligated on the loan. If certain major changes occur, a new 3-day waiting period can be triggered. The section explained how the closing disclosure is laid out. Page 1 summarizes key items such as loan amount, interest rate, monthly principal and interest, estimated monthly payments, and the total cash needed to close. It also shows basic transaction and loan information, so the borrower can confirm they are looking at the correct property, loan type, and parties. Page 2 itemizes all closing costs, clearly showing what the borrower, seller, and other parties are paying, and whether payments are made at or before closing. Page 3 compares the final numbers to the original loan estimate and calculates the borrower's cash to close, as well as summarizing the seller's side of the transaction. Page 4 explains important loan features like assumptions, late fees, negative amortization, partial payments, collateral, and escrow accounts. Page 5 provides the big picture loan calculations, total of payments, finance charge, amount financed, APR, and total interest percentage, followed by other legal disclosures and contact information for the lender, broker, and settlement agent. The main takeaway is that the closing disclosure is now the central consumer document for understanding the cost and structure of the loan and the transaction. As an agent, being fluent in its layout and purpose allows you to guide buyers and sellers through the numbers and spot issues early. Reporting requirements and recording. The final section addressed what happens after the money changes hands and the documents are signed. Under the Tax Reform Act of 1986 and related laws, certain parties in the transaction, often the settlement agent or broker, must file information returns, such as Form 1099-S, with the IRS to report sales proceeds and other relevant information. Brokerages must also issue appropriate information returns when they pay commissions to co-brokers or independent contractor agents. When a foreign seller is involved, you learned about the Foreign Investment in Real Property Tax Act, FIRPTA. FIRPTA requires that a portion of the gross sales price be withheld and sent to the IRS when a foreign person disposes of a U.S. real property interest, unless an exception applies. Typically, the buyer is considered the withholding agent and can be held liable if the required withholding is not made. There are exceptions based on price and intended use as a residence, and there are procedures to apply for reduced withholding. But the key message is that FIRPTA must be addressed proactively in any transaction involving a foreign seller. The section also explained why and how documents are recorded. Deeds, deeds of trust or mortgages, releases, assignments, and other property-related documents are recorded at the county recorder or similar office. Recording gives constructive notice to the world about ownership and lien rights and helps establish priority between competing claims. The recorder's job is to ensure documents meet technical requirements and to index and archive them. The recorder does not guarantee legal validity. Priority disputes are resolved under state rules such as race, notice, or race notice statutes, which emphasize the importance of promptly recording your interest. Discussion. How does understanding the closing disclosure and settlement statement make you a better advocate for your clients at closing? Suggested answer. When you understand how the closing disclosure and settlement statement are built, you can quickly see whether numbers match the contract, whether prorations are fair, and whether fees comply with expectations. You can explain cash to close figures to buyers, net proceeds to sellers, and help catch errors before signing. This reduces last-minute stress, builds trust, and helps prevent disputes after closing. Why is it so important to identify a foreign seller early in the listing or purchase process? Suggested answer: if a seller is a foreign person under FIRPTA, withholding rules apply and can significantly affect the seller's net proceeds and the buyer's responsibilities. Identifying this early allows the parties to plan for withholding, consult tax professionals, consider applications for reduced withholding, and ensure the settlement agent structures the closing correctly. If this is discovered at the last minute, it can delay closing or create serious liability for the buyer and settlement agent. Closing remarks. Chapter 21 showed you that closing is much more than a date on a calendar. It is the point where contracts, financing, title, taxes, and law all converge. You now know how escrow protects both parties, how RESPI and TRID make loan costs more transparent, how debits, credits, and prorations turn agreements into real numbers, how taxes and insurance tie into closing, how to interpret the closing disclosure, and why reporting and recording are essential for tax compliance and legal certainty. With this chapter, you are better equipped to guide your clients from under contract all the way to recorded and closed, minimizing surprises and maximizing professionalism at every step.